Hello everyone, welcome back to another video. Today I will not talk about a specific stock, but I will talk about options trading and the strategy I'm currently using to generate kind of a passive income in the stock market. I know this video was long overdue since a lot of you have asked for it in the comment sections of a lot of videos and in the Discord group chat. So please smash that like button and subscribe if you haven't already, since that helps a lot the channel out. Also, I have a completely free Discord group chat, which the link for that is down in the description below. Also, I will be leaving timestamps down below in case you already know about a topic I'm talking about and you would like to jump to the next one. I do first want to say that options is not an easy topic to talk about. There is a lot of things to understand and we could be here talking for hours and hours about this topic because options are not as easy as buying a stock, and also there are different strategies you can approach with options. I do want to explain the basics of options, kind of an options 101 for any of you that might have no idea what I'm talking about, and then I will talk about the cover call strategy, which is the current strategy I'm using in my portfolio. There are way more, such as wheel strategy, cash cover puts, and more. I do know that it is difficult to understand at the beginning because when I started with options trading, I watched tons and tons of videos and read books about it, and still was left with a lot of questions. But I will do my best to explain it the most simple way possible. I will show you guys what I will be doing in my iPad so you can understand it hopefully way better after this video. Also, you need to know that options are not easy. It is not like you will convert into a millionaire tomorrow by trading options. It is very, very risky. You can earn money, a lot of money really fast, but lose it way faster. I remember when I started, I had a 99% return in the very first week. I will post a screenshot right here if I find it because I know that I took one and I felt like I knew everything and that I was going basically to make a lot of money every single day. Oh boy, was I wrong. I'm not saying that it is impossible to make money from trading options. I got into an options trading group and have to say that the owner of the group seems to be very, very intelligent and that he knew what he was doing. The thing is that he has been trading options for years and years. He has studied a lot of different strategies, have studied how to read the charts and more. And that taught me that it is not something that you will learn in a single night. I would recommend you guys open a paper trading account with TD Ameritrade to trade options with fake money while you learn so you don't lose real money until you feel very, very comfortable with it because it's really risky. Now, my strategy, the one that I'm going to talk about in this video after the intro to options 101, is more simple and I think it is easier to understand and less stressful in my opinion. But let's start. First, what are options or options contract? They are, as the name says it, contracts that give the investor the right but not the obligation to buy or sell the underlying asset, which in this case we're talking about stocks. Then you have a call option and a put option. A call option is just a contract between the buyer and the seller that gives the buyer the right to buy 100 shares of a stock at a strike price. Meaning that if you buy a call, it is because you think that the stock will go up, and if you buy a put, you think that the stock will go down. Let's take Apple as an example. I'll be using a screenshot from Robinhood as an example for this video since it is a platform that I've been using since I started with options. So if we go to Apple stock and you select the trade app right here and then you click the trade options, you will see this. On the top, you will see different dates in which your contract will be expiring. If we select February 12th, you then will be able to see all the available contracts for call and put options. Now, let's understand what the app is showing us. So to start, this right here is a strike price. The strike price tells us that if you buy this call option contract, you will have the right to buy 100 shares of Apple at this price, which in this case is $136 each. Then we have in the money, at the money, and out of the money option contract. In the money contracts are those in which the strike price is below the current share price. In Robinhood, all the call options contracts below this line with the share price are in the money. Every contract above the share price or above this line is out of the money. And the contracts that the strike price is the same as the stock price, then those are called at the money. there you understand what a strike price is, in the money, out of the money, and at the money contracts are. For a put option is the other way around. Every contract above the line is in the money, and every contract below the line is out of the money. Now, this number right here indicates the price of the option contract. So if we take as an example a contract with a strike price of $136, you will pay a premium of $1.74 per share, and since each contract represents 100 shares, you would pay $174 for a whole contract. You can see that the more in the money the contract is, it gets more and more expensive because you will be able to make a bigger profit if you decide to exercise that option. Obviously, as the stock price fluctuates, the option contract will fluctuate as well. If Apple stock goes higher, the option contract price will go higher as well, and you would be able to sell it for a profit. And that is what we call trading options. Now, what is the premium, or what does it really mean? The premium is the price I told you before that you pay per contract, which in this case is $1.74 per share, but the premium for the in the money options is the intrinsic value plus the extrinsic value. The intrinsic value is just the profit you could generate if you exercise the option. For example, if you buy this contract with a strike price of $136 per share, you now would have 100 shares of Apple with an average cost of $136 per share, but the stock price is actually at $136.56. So you would have a profit of 56 cents per share, which if you multiply by the 100 shares that you own, you will have a total profit of $56. So out of the $174 that you are paying as a premium for the call option, $56 is the intrinsic value, and the rest is the extrinsic value. The extrinsic value is the value given to the option because of the time left to expiration. Remember, this contract will expire on February 12th, so 1 week from now. And while the time passes, that extrinsic value could decay really fast if the stock trades sideways or against you. The more in the money, the more valuable it will get, since the extrinsic value will get more expensive. Obviously, out of the money options do not have any intrinsic value, since you will not be making any profit because you cannot exercise that contract, since it will expire worthless. So now you are able to understand why this option contract costs $174 per contract, and why or how the prices fluctuates depending on what the stock is doing. Now, something important to understand, mostly for people that want to trade options, is to understand all the statistics of each contract. To start, the bid and the ask are just the same as with a stock. The bid are the buyers, which always want to buy at a lower price, and the ask are the sellers that want bigger profits and sell higher. The volume is the total number of contracts traded, which you always want that number to be high, since that means that there are a lot of people trading that same contract, and it will let you get in and out really fast. Then the open interest is the number of contracts open. For example, there are over 5,600 of this call option open. Then the Greeks, one of the most important things to understand, yet one of the most difficult ones at the beginning. The first one is delta. Delta shows you how much money the option premium could go up or down every time the stock prices increases or decreases by $1. For example, if you buy this contract and Apple goes up $1, the value of the contract will increase 38 cents, so you would be on the green by 38 cents per contract. But since each contract is 100 shares, you would be up $38. And if it goes down $1, then you will lose $38. Then we have gamma. Gamma is basically how much delta changes if the stock change $1 up or down, since delta is not consistent. So now you know that you can have a profit of $38 if the stock goes up $1, but also that your delta will increase $5 if the stock goes up $1. Then theta. Theta is one of the most important ones, in my opinion, for long-term and swing trades, since it tells you that every day you are holding this contract, you will lose that amount of money from your premium. Remember, I told you at the beginning that the extrinsic value would decay with time. Well, theta tells you how much it will decay per day as you get closer to expiration date. In this case, you would lose $14 each day. Obviously, while stock prices goes up, theta changes as well. Then we have vega. Vega tells us how much your premium is gonna change based on a 1% change in implied volatility. If implied volatility increases, you are going to make $8. Implied volatility is basically the hype around the option contract from all the people that are wanting to buy more of that same contract. Even though volatility is very good for options, because that will help you make money, you should always try to buy options when implied volatility is low and sell them when it's high, since Vega would increase while implied volatility increases and you would make more money. All that I just explained, from what is a call or a put option and all the way to the stats of a contract, is very, very important for you to understand before trading options. Now let's talk about my strategy. It is funny I call it my strategy because it's not mine. A lot of people use this strategy, but it is the one that I'm currently using. It is called cover calls. And how does cover calls works, you may ask? Well, let's say that you love Apple and you have 100 shares of Apple. When you own 100 shares of Apple or any company, you are able to sell a call against it, which is called write a call option. Writing a call is selling a call option that you don't own and collect the premium from selling it. Before I was talking about buying calls and puts. Here I'm talking about selling the call. When you buy a call option, you have the right to exercise the contract, but when you sell the call option, you are giving the right to the person that is buying your contract, which means that you need to have 100 shares of the stock available to be able to sell them to the buyer of the call option in case he decides to exercise the contract. Don't worry, I know it sounds very confusing, but I will do an example for this video. But when you write a call option or sell a call option, there are two possible outcomes. First, the call option expires worthless out of the money, which means that the strike price is way higher than the stock price. If this happens, you will keep your shares and the premium that you collected from selling the call option. The other outcome that would be that the stock price rises a lot and your call option expires in the money below the line that I told you. This means that the person that bought your contract now is able to exercise it and buy your 100 shares at a strike price that you selected to sell your contract. In this case, you will lose your shares and will only keep the premium that was credited to your account from the call option that you sold, plus you will now receive the money from that 100 shares that the other person bought from you. Now let's do an example so I can show you better, since it is way easier than it sounds. For this example, I'm gonna use Wish, since it's the stock that I'm currently using for this strategy. As you can see, I own 200 shares of this stock, which is a total of $5,870. Now let's try to sell the call option so you can see how it works. If you click this tab right here, the trade tab, and then go to trade options as I showed you before, here are the expiration days, and you can see that there are not a lot of them in comparison to other stocks, because this is a very new stock that went public last year and you only have 4 expiration days. For me, I'm gonna select February 19th since this is the nearest one. And as you can see, I bought 100 shares at $29.80. So if I want to sell a call option, I would have to sell a call option of a strike price of 30 or above, because if I do it below, I will lose money, and then you're going to see why. So I would like to then sell the $30 strike price call option, because for me is the one that gives me the most premium, since it gives me $2.35 per contract, which is $235. So in order to sell it, you have to be sure that here is selling and here you have a call and not a put. Then you select the contract that you would like to sell and decide to sell one. As you can see here, I will receive mean credit as $235. Let's say that I don't like that and I want to sell it for $250. Then I put here $2.50. You click review and then swipe up. Obviously, it's not gonna feel right now because it is not $250, it's $235, but I will leave it there because I want to sell it for $250. Now, remember that I told you that I prefer to sell the $30 call option because if not, I will lose money. Okay. I bought the 100 shares at $29.80. So I will collect a premium of $250 if this order fills, plus the profit if they take my option. So if they take my stock. So if by February 19th the stock price is above $30, then the person that bought my contract will buy my 100 shares. Meaning that If the stock price, let's say it is at $32, then that person will buy my shares at $30. But if I bought them at $29.80, I will be profiting 2 cents per share, which if we multiply by the 100 shares, that will be $20. Plus the $250 that I will be receiving from the premium, that will be a total of $270. Now, obviously, that is not a lot of money. It is a lot of money, but it's not a huge amount of money if you compare it with other stocks. But actually, if you check it, that is almost a 10% return, because it would be $270 divided by $29.80. That would be a 9% return within 2 weeks. I know that 9% return is not that much when you compare it with Tesla, but believe me that this is a huge amount of money. Now, let's do a comparison with my other 100 shares. Last month, I bought 100 shares of Wish at a price of $18.19, meaning that I sold, as you can see, a call option with a strike price of $20. At the moment, I collected $240. So now, obviously, I will lose these stocks because the share price is at $29. And I don't think it will get to 20 by February 19th. Maybe it will. Hopefully it will. But if not, they will take my shares. So for that contract, I will actually earn $20 minus the 18.19, which is the price that I paid per share, and multiply that by 100. That will be $181 plus the $240 that they paid me for the premium of the call options. That will be $421 plus the $270 that I'm making for the other 100 stocks. That's a total of $691 from an investment of $4,700. That's actually a 14% return in 2 to 3 weeks. That's a lot of money. Obviously, you need to invest money to make money, but still, it's a lot of money. Now, when you lose money, now obviously for this option of $20, with a strike price of $20, I'm losing profits, let's say it that way. Why? Because the stock price is actually at $29.35. So if I bought every share at $18.19, I would be profiting $11.16 per share, which that would be $1,616 per share if I would have waited and just sold the stocks today at a price of $29.35. But that is one of the risks that you take when you do cover calls. Obviously, I'm very comfortable selecting the $30 strike price, even though I know there is a huge possibility that I will lose my stock because it is a very volatile stock and it is almost at $30 per share. The downside of this strategy is that if the stock price goes down and you want to sell your shares, then that is no good for you because you will keep your shares. Obviously, you will be collecting the premium, but now you could be losing money out of the stock since it is dropping. Obviously, in my case, if that were to happen, I really don't care because I researched the company and I like the company. I do not mind holding the shares and continue selling call contracts every time I can. Now, another downside is that if the call expires way in the money, you will lose money. As I explained to you that what is happening with my other 100 shares that I sold a contract for $20 per share. Now, not all the stocks give you a nice return in cover calls. If you look, let's say, for stocks like Palantir, let's look for Palantir. Okay. And you click trade options, and select, let's say, February 12th, because that's a week away. You will see that they will give you $1.84 or $184 for an investment of $3,196. Obviously, that is a lot of money as well. That's 184 divided by 31.96. That's 5.7% return in a week. That's actually a lot of money. But if we compare it with stocks like, let's say, Fubo TV, which is another huge stock that I'm watching because I would like to do cover calls with this, you can see that they will give you a premium of $518 when you invest $5,071. Obviously, this type of stocks is really difficult to do it, or it's actually awesome to do it, but risky because it's a volatile stock. As you can see, the stock is up 247% in 3 months. 79% in a single month. If we buy right now at $50, the stock might be at $30 in a month, and you will be losing a lot of money. Yes, you will collect $500 from your premium, but you will be losing a lot of money from your investment. That is why you need to do it with stocks that you like and don't mind to hold long term as well. Also, if you have more money available, you can always double down and sell calls with a cheaper strike price that will give you a better premium. I think this is a nice strategy to make a little more passive income. You will not be risking that much as you might with trading naked options, but you would be able to make a passive income out of it. Again, options is not for everyone. Not everyone like it, and a lot of people think it is very, very risky, which it might be because you are able to lose a lot of money. And that is why you should know your risk tolerance and invest in what you feel more comfortable. If you have any doubt or something is not clear yet, feel free to DM me on Discord or Instagram, and I will do my best to help you out, because I know this is a hard topic to understand at the beginning, and let me tell you that once you start doing it, you will understand it way faster. That's why I'm telling you that I recommend you open a paper trading account with TTMA Trade. That helped me a lot. Also helped me putting money into Robinhood and buying options, but you can lose money doing that. Let me know in the comment section below if you would like me to talk more about options in the channel, and if you like this video. Thank you everyone for watching. Hope you enjoyed this video. Please smash that like button and subscribe, since it really helps the channel out. Thank you, and see you next time.